Hi everybody, Jeff Yastine here. There's a certain residence that I drive past on my way into work most mornings, and the owner put it up for auction in recent weeks, and it is a sign of the times. The new reality of the luxury real estate market is that it is not cooperating with the opulent hopes and dreams that the owner had for his property. Now, maybe it's the asking price of the last few years, $159 million, that had something to do with it. You might have read about La Palais Royale, the 60,000 square foot mansion that sits on a little over 4 acres of prime South Florida beachfront. As the mansion's real estate agent put it back in 2015, no corner was cut, nothing was too expensive, they wanted the best of everything. That includes $3 million worth of gold leaf, encrusting the front gate and entryways, and for a time there was even talk of adding a helipad and a $7 million personal entertainment complex, complete with a Star Wars themed indoor go-kart track on the adjoining lot to this mansion. Now, those plans never materialized, and neither did a buyer. Now, that's the story everywhere these days. Even the once booming luxury home market in the San Francisco area has cooled off to a huge degree. September was the region's slowest sales month in about 11 years. Now, as stock investors, what are we to make of all this? Well, think of the mansion as a poster child for the rougher, tougher investing environment that we all face these days. We're in an era of rising interest rates and less liquidity, declining liquidity, and both of these trends are courtesy of the Federal Reserve's policies over the last few years as they've tried to normalize the interest rate situation. So that means for investors that we have to look harder for value, such as the positions that I have in the Total Wealth Insider model portfolio. And in recent months, I've also noted many times the great values to be had in certain sectors like consumer staples and among certain companies in the retailing and telecommunications areas as well. And like that beachfront mansion, we can't buy stocks for show anymore. What I mean by that is that there's no more bragging about the stocks that we own like so many people did, so many of my neighbors have, regarding the so-called FANG stocks, Facebook, Apple, Amazon, Netflix, and Google, because that was the cool things to own regardless of price or overvaluation. Now, for a legion of investors, those stocks were the only stocks to own in the last couple of years, but the declines of the past month, an average of around 27% between those 5 stocks, shows that no stock and no sector is immune when the Fed acts out its part. So what do you do now? Well, this is one of those moments when it really pays to have some easy cash on hand so you can put money to work at an opportunistic time. There's a wholesale exodus going on right now among the premier companies in the technology sector, and it's quite likely that when the smoke clears, more than a few of yesterday's overvalued tech stocks will likely be tomorrow's undervalued value stocks. So if you'd like to learn more about this, make sure you click the link right here in the video. I'm Jeff Yastine.